Hey, TSP crew. This is Matthew Searsley of Agris Tax Advice. No, it's been a little while. I've been under the weather for a while, but I am back here today to answer another listener question. I am going to be selling one of my businesses. What can I do to reduce capital gains tax? More information. I have a bagel shop that I've owned for 4 years. I'm getting ready to sell it. I currently rent the location it's in. I own all of the equipment and inventory. There's no debt on the business. What ways can I shelter or invest the profits to help me reduce the capital gains tax? Well, I'm going to give you an answer today, but I'm going to start with the really annoying truth. To really answer this question, I need way more information about how you're structured, how you're taxed, and where you're located. If you're a sole proprietor or an LLC or an S Corp or a C Corp, these answers are going to be different. And if you're in New York City, we're going to do it different than if you're in Miami, and different probably if you're in, say, Chicago. But I can at least talk about some of the big levers to move the needle. And here's the thing. The IRS wants your sale to be the payday, and you want a strategy to avoid that. Now, what other thing? You said you want to avoid capital gains, but actually, when you sell a business, it depends on how you sell it for if it's taxed. If it's in an LLC or a corporation and you sell the shares, it's a capital gain. But very often, it's what's called an asset sale, where they just buy your inventory, your equipment, your name, your goodwill, but they don't take your LLC. And when that happens, some of that gets taxed as ordinary income. Some of it can be taxed as depreciation recapture, which is the exact same income tax rate as ordinary income. And some of it is capital gains treatment. So step one isn't even what can I invest in to avoid this. Step one is we need to allocate the price across the different buckets. And while there are 7 different buckets, typically you're looking at 3: inventory, ordinary income; equipment, any depreciation you've taken, you pay recapture, which is ordinary income; goodwill, capital gains treatment. You've held this for long enough, you're in long-term capital gains land, so goodwill is going to save you money on your taxes, but you and the buyer will have to agree how to split the payments into these different categories. And the buyer is going to want it to be as much inventory and equipment as possible and as little goodwill as possible. So you need to make sure that you are agreeing with this on your LOI, your contracts, etc., to make sure you're getting the best tax treatment possible. Now, first big thing you can do it as an installment sale. If you don't need all the cash, and if you trust the person to pay you, or if they have assets, don't take all the money in the first year necessarily. Now, all of the inventory and equipment, you owe tax on that in the first year, whether you get the money or not. So make sure you get enough money to pay that tax. I've seen these deals fall apart over that. But if you spread out that capital gains, sometimes you can get much better tax treatment. Now, sometimes it's worse tax treatment. Sometimes it really is better to just get it over with right now, but that's something to consider. The next big lever I would look at for you is what's called a charitable remainder trust. This is a really advanced thing. It's really easy to screw this up. You need a CPA or an attorney to help you with this. It's a little bit complicated. Basically, you take your business or the assets of your business and you put it in a trust. And while you're alive and while your spouse is alive, you're allowed to use the money you make from the sale to invest, etc., to take that out and to live on it. When you and your spouse die, all of the money in that trust will go to charity. So you are going to lose it. The benefit is this would completely avoid tax on this entirely, because legally you gave the whole thing to charity. And again, the thing that makes this kind of nice is, let's say it's, I don't know, $1 million. Well, you now have $1 million you can invest and earn money for and take that out while you're alive, and you don't pay the capital gains tax and the ordinary income tax on that $1 million. The fourth level is the one that's the most exciting, and it's one you can't do based on what you've told me. But this is one of the holy grails of tax law, no tax at all. So the problem is you have to, well, and they changed this in One Big Beautiful Bill. To use this, you have to have a C Corp, and you have to have held the stock in the C Corp for at least 5 years. But then when you sell that business, the first, I believe it's $10 million of gain is income tax free for you. They made this a little bit better in the One Big Beautiful Bill, where if you don't make it 5 years, but you make it 3 or 4 years, you get some of the benefits. But unfortunately, it's not retroactive. It only applies if you got the stock in 2025 or later. Since you said you own this for only 4 years, I assume this does not qualify, especially if you are a C Corp, and you're probably not. This would be a reason to maybe delay the sale, especially if it's not 4 years, but it's 4 years and 10 months. Waiting that extra 2 months could make the whole thing tax-free. Now, here's the don't screw up section. Don't wait until you signed a deal to start planning. Once you sign that contract, a lot of what your options are gone, including it's even too late to do the charitable remainder trust because the contract's got to be between the trust selling those assets to him instead of with you. Same thing on the installment sale, same thing on how you're doing the division. Don't assume it's all capital gains unless you are actually selling your stock or your LLC directly as opposed to the assets. Don't ignore state taxes. Some of these strategies work to help with state taxes, some don't. Some states honor installment sales, some don't. So you need to make sure you're not just doing federal planning, but if you have state capital gains taxes or state income taxes, and some states have one and not the other, you need to make sure that you are planning for the state as well as the federal. This is a situation where the terms of the deal tend to be much more important than the dollar amount. You might gladly sell for 10% less, but if you get to pick how the deal gets done, you might end up with more money in your pocket at the end of the day. Well, if you want an answer customized to you, the next step is simple. Reach out to me or another attorney or CPA. You or any one of my listeners can reach out to me at agristaxadvice.com/TSP. You'll get a whole tax toolkit of tips and ways to save money on your taxes, and you'll get a chance to schedule a free call to see if I can help you. Have a great day, everyone.